Hi guys! Enjoy John's analysis.
He is 94 years old. He has spent 6 decades building the most respected investment track record in the history of American capitalism. And in May of 2018, standing in front of 40,000 shareholders at the Berkshire Hathaway annual meeting in Omaha, Warren Buffett said 4 words about Bitcoin that became the most quoted sentence in the 16-year debate over this asset. Rat poison squared. Not rat poison squared. The mathematical escalation was intentional. Buffett did not say Bitcoin was a bad investment. He said it was a bad investment multiplied by itself, an exponential of wrongness. And sitting next to him, his partner, Charlie Munger, the vice chairman of Berkshire Hathaway and one of the most respected investors of the 20th century, called trading Bitcoin just dementia. 2 of the sharpest analytical minds in the history of finance. Decades of compounding returns, a combined net worth at the time of over $100 billion. And they were looking at the same asset that, in the 7 years since Buffett's comment, multiplied in value by approximately 13 times. Either Buffett and Munger were catastrophically wrong about the most important new asset class of the 21st century, or they were right about something that Bitcoin enthusiasts still refuse to fully reckon with. This video argues both are true simultaneously, and understanding how that is possible is the difference between reacting to Bitcoin's price and understanding Bitcoin's purpose. My name is John. If you want to understand the real architecture of this debate, not the cheerleading version and not the dismissal version, hit subscribe right now. What I am about to show you is the most important intellectual framework for thinking about Bitcoin that most people in this space have never heard, because it requires first admitting that the people who hate Bitcoin are, on the most important points, completely correct. Before we go further, this video is for educational purposes only. Nothing here is financial advice. Consult a qualified professional before making any decisions about your specific situation. Drop a comment right now before we get into the argument. 3 things. What city you're in, what time it is there, and what the weather looks like outside your window. I read every single one. And if you have tried to explain Bitcoin to someone who gave you the Buffett argument and shut the conversation down, tell me that story too. Because that experience is exactly what this video is built to resolve. Part 1. The critics are right, and here's the proof. Let me start by doing something almost no Bitcoin video ever does. I am going to make the strongest possible case against Bitcoin, using verified data, not caricature. I am going to make it completely, without flinching, because the only way to understand what Bitcoin actually is requires first understanding why the critics are not stupid. The first and most powerful critique is volatility, not the generic, it goes up and down version of this argument, the measured, quantified, institutional version. According to Winthrop Wealth's analysis published in 2025, going back to 2015, Bitcoin has experienced 34 separate bear markets, defined as a decline of 20% or more without a subsequent 20% recovery. The S&P 500 experienced 2 in the same period. That means Bitcoin enters a bear market an average of 3.4 times per year, meaning that in any given year, a Bitcoin holder experiences something that would be classified as a market crisis in the equity world, 3 separate times. BlackRock's own data, published in January 2025, puts Bitcoin's annualized volatility at approximately 54%. Gold's volatility over the same period was 15.1%. Global equities were 10.5%. Bitcoin is not somewhat more volatile than other assets. It is 3.6 times more volatile than gold and 5 times more volatile than a diversified global equity portfolio. State Street's September 2025 research confirms the crisis behavior directly. During peak to trough drawdowns greater than 12% in the S&P 500 since Bitcoin's inception, gold returned an average of positive 4.7%. Bitcoin fell an average of 35.3% and did not post a single positive return in any of the 7 measured episodes of market stress. That is not a coincidence. That is a behavioral pattern. And it is the behavioral pattern that contradicts the most common retail argument for Bitcoin, that it is a safe haven, a digital gold, an asset that goes up when everything else goes down. The data says the opposite. Before we leave the volatility argument, one more data point. According to Fidelity Digital Assets Volatility Research, Bitcoin's annualized realized volatility stood at 52.2% as of the end of Q1 2025, down significantly from the triple digits it once occupied, but still dramatically above every other major asset class. Fidelity's own analysis notes that Bitcoin is currently less volatile than 33 individual stocks in the S&P 500, which contextualizes the volatility argument without eliminating it. The trend is toward lower volatility. The current level is still 5 times global equities. Both facts are simultaneously true, and both belong in any honest analysis. The second critique is the one Buffett made in its sharpest form. In 2022, at another Berkshire annual meeting, he said, "If you offered me all the Bitcoin in the world for $25, I would not take it. Because what would I do with it? I would have to sell it back to you one way or another." That statement is not a misunderstanding of Bitcoin. It is a precise description of the problem with assets that produce no cash flow. A farm produces food, a factory produces goods, an apartment produces rent, a bond produces interest, a stock produces earnings. Bitcoin produces nothing. Buffett later told CNBC more directly, "Bitcoin has no unique value at all. It is a delusion, basically. It is a gambling device. It just sits there, like a seashell or something, and that is not an investment to me." These are not off-the-cuff remarks. They are the consistent, considered, publicly documented position of the most successful value investor in history, repeated over a decade. In December of 2024, when Bitcoin's market capitalization crossed $2 trillion, Eugene Fama, the Nobel Prize-winning economist known as the father of modern finance, the man who invented the efficient market hypothesis, said the probability of Bitcoin being worth 0 in 10 years was, in his assessment, close to 1. Not close to 0, close to 1. The man whose theoretical framework underlies the entire structure of modern portfolio management assigned near certainty to Bitcoin's eventual worthlessness. That is not a fringe opinion. That is the most decorated financial economist alive, speaking on the record. The third critique is regulatory risk. China banned Bitcoin. Not restricted it, not taxed it, banned it, declared it illegal. And the price did not go to 0, but the episode proved something that Bitcoin advocates have never satisfactorily answered. A sovereign government with sufficient will can unilaterally close the access window to this asset for everyone within its borders. 1.4 billion people lost legal access to Bitcoin by executive decree. No other major asset class, not equities, not bonds, not real estate, not gold, can be eliminated with a single regulatory announcement in the way Bitcoin can be targeted at the infrastructure level. The regulatory argument is not theoretical, it is precedent. And every country that has not yet acted is not proof that they will not. It is proof that they have not yet. Bitcoin's legal status is subject to the political will of every sovereign government in every jurisdiction where it is held. These three critiques, volatility without precedent, absence of cash flow, and sovereign eliminability, are not marketing points made by uninformed skeptics. They are empirically documented structural features of the asset. Anyone who has tried to build a case for Bitcoin without fully acknowledging them is building on sand. If you made it this far, you are not the average viewer. Most people make a decision in the first 90 seconds. You are here at the exact pivot point of this video, the moment where the intellectual architecture of both sides is fully on the table. Before we continue, I want to know who is watching. Drop a comment below, your city, the time, and the weather outside your window right now. I rate every single one, and this is the best part of my work. I really enjoy seeing the places this message hits. So let us move on. Here is the intellectual pivot that this video is built around. Warren Buffett evaluates every asset through a single lens. Does it produce something? Does it generate cash flow, earnings, or dividends? That framework has made him the greatest investor of the 20th century. It is also a framework built entirely for a specific type of asset in a specific type of economic environment. Buffett used the same argument against gold. He has repeatedly pointed out that gold produces nothing, generates no earnings, and sits inert, making it, by his framework, no different from Bitcoin. But here is what that comparison reveals. The gold market, as of 2025, was a $24 trillion asset class. It is held as a reserve by central banks in dozens of countries. It is embedded in the balance sheets of the most conservative financial institutions in the world. And it produces absolutely nothing. If Buffett's argument eliminates Bitcoin from consideration, it also eliminates gold. And if gold is worth $24 trillion despite producing nothing, then the question is not whether non-productive assets can hold value. They demonstrably can. The question is what makes them hold value, and whether Bitcoin shares that mechanism. The IMF's Finance and Development Journal published an essay in December of 2025 that addresses this directly. The author cites Nobel laureate Robert Mundell, the economist whose theoretical framework laid the foundation for the euro, who observed that gold endures not because of intrinsic utility, but because of what Mundell called the trust we place in its uselessness. The full framing from the IMF essay is illuminating. Gold's worth cannot be reduced to geology. It derives from a shared social consensus, a collective belief that this particular metal, among all others, embodies safety and value. That consensus, not the metal's chemistry, is what makes gold a $24 trillion asset. Buffett is correct that gold produces nothing. He is correct that its value depends entirely on collective belief. What he misses is that collective belief is itself a real and durable force in monetary economics, arguably the only force that makes money work at all. The US dollar produces nothing and is backed by nothing except collective belief in US sovereign credibility. Every fiat currency in the world is, at its foundation, a collective belief system with legal enforcement mechanisms attached. The question for Bitcoin is not whether it has intrinsic value in the Buffett sense. Nothing monetary has intrinsic value in the Buffett sense. The question is whether the consensus around Bitcoin is being built on a foundation durable enough to survive, and whether the conditions that would make that consensus relevant are present or approaching. The question for Bitcoin is not whether it has intrinsic value in the Buffett sense. Nothing monetary has intrinsic value in the Buffett sense. The question is whether the consensus around Bitcoin is being built on a foundation durable enough to survive, and whether the conditions that would make that consensus relevant are present or approaching. There is a second intellectual problem with the no intrinsic value argument that almost no financial commentator addresses directly. When Buffett makes the case against Bitcoin, he implicitly makes the same case against cash. A dollar bill produces nothing. It generates no earnings, no dividends, no cash flow. Its entire value is a collective belief, backed by legal tender laws and the military and economic power of the sovereign issuing it. The argument that Buffett uses to dismiss Bitcoin, applied consistently, dismisses every currency ever issued by any government in history. The difference between the dollar and Bitcoin, in Buffett's framework, is not that the dollar has intrinsic value. It does not. The difference is that the dollar has a sovereign guarantor and Bitcoin does not. But here is what that distinction actually means in the context of the GAO's data. A sovereign guarantor is a liability, not just a guarantee. The same government that guarantees the dollar's value is the same government running a fiscal deficit that the GAO calls unsustainable. The sovereign guarantee on the dollar is only as good as the sovereign's ability to honor it. And the sovereign is, by its own watchdog's published analysis, on a path toward a debt load that its own economy cannot service under current policy. The guarantee is backed by the credibility of the guarantor. The credibility of the guarantor is backed by its fiscal position. The fiscal position is, per the GAO, unsustainable. That chain of logic does not end at Bitcoin being correct. It ends at the question deserving a serious answer. On October 31st, 2008, a person or group operating under the pseudonym Satoshi Nakamoto published a 9-page document on a cryptography mailing list. The document was titled, Bitcoin, a peer-to-peer electronic cash system. The first sentence of the email distributing it read, I have been working on a new electronic cash system that is fully peer-to-peer, with no trusted third party. The date matters. October 31st, 2008 was exactly 2 weeks after the Emergency Economic Stabilization Act of 2008 was signed into law. The $2 trillion bank bailout package that the U.S. Congress authorized to prevent the collapse of the American financial system. Lehman Brothers had declared bankruptcy 46 days earlier. Washington Mutual had failed. Bear Stearns had been acquired in a government-arranged fire sale, and in the middle of all of it, an anonymous person or group published a blueprint for a financial system that required no trusted third parties, no banks, no central banks, no governments, and no bailouts. The Genesis block of Bitcoin, the first block ever mined, on January 3rd, 2009, contained an embedded message. Satoshi coded a newspaper headline directly into the block data, Chancellor on brink of second bailout for banks. That is the front page headline from the London Times on January 3rd, 2009. Satoshi did not timestamp Bitcoin's birth with a random phrase. He timestamped it with a headline about governments rescuing banks from the consequences of their own failures. Now, that was not a coincidence. It was a thesis statement. Bitcoin was not created as a speculative investment. It was created as a protest, a technological response to the moment when the world's most powerful governments demonstrated that they would print unlimited money, bail out the institutions that caused a financial crisis with the savings of people who had nothing to do with causing it, and suffer no consequences for doing so. The people who hate Bitcoin for being speculative are criticizing an asset for behaving in ways its creator explicitly did not intend. The question the white paper was answering was not, how do I make money? The question was, what happens when you cannot trust the institutions that hold your money? What happens when the banks fail and the government that was supposed to regulate them bails them out with everyone else's resources, and the people who designed the system that failed remain in charge of designing the next one? That question was asked in 2008 during a financial crisis. It is being asked again in 2026, not during a crisis, but during the slow, documented accumulation of conditions that historically precede one. Satoshi's thesis was not that governments are evil. The thesis was that trust in institutions should be verifiable rather than assumed, and that a financial instrument whose properties could be verified mathematically, rather than taken on faith in a regulated institution, was worth building. The white paper's opening sentence established the stakes. What we propose is a system for electronic transactions without relying on trust. Every criticism of Bitcoin that points to its volatility, its lack of cash flow, and its regulatory vulnerability is a criticism of the surface properties of an asset, not of the question it was designed to answer. And that question is more relevant in 2026 than it was in 2008, because the debt that caused the crisis Satoshi was responding to has tripled since then.
Hey guys, I need a quick favor from you. If you're enjoying this video, please smash that like button and hit the hype button after. It really helps the channel grow and tells the algorithm that this kind of deep macro plus Bitcoin content deserves to reach more people. Takes literally 2 seconds, but makes a huge difference for us. See you.
Here is a number published not by a Bitcoin advocate, not by a hedge fund, not by a crypto exchange, but by the U.S. Government Accountability Office, the independent, nonpartisan investigative arm of the United States Congress. As of September 30th, 2025, the federal debt of the United States was $37.6 trillion, up $2.2 trillion in a single fiscal year. Interest on the debt in fiscal year 2025 reached $1.2 trillion annually. The GAO's report, titled The Nation's Fiscal Health, published in February 2025, used language that the government's own watchdog has never used lightly. The report stated, "The federal government is on an unsustainable fiscal path that poses serious economic, security, and social challenges. Not a challenging path, not a concerning path, an unsustainable path. The GAO projects that, under current revenue and spending policies, publicly held debt will reach 200% of GDP by 2047, meaning that by the middle of this century, the United States government will owe to its public creditors twice the total value of everything the American economy produces in a year." The GAO confirmed a number that should appear in every honest discussion of monetary risk. Government spending on net interest in fiscal year 2024 exceeded federal spending on both Medicare and national defense. The United States of America spent more money in 2024 paying interest on its accumulated debt than it spent defending itself or providing health insurance to its elderly citizens. According to the Congressional Budget Office, federal deficits are projected to exceed $2 trillion annually over the next decade. Not in a recession, not during a war, but under current baseline law and normal economic conditions. According to the Congressional Budget Office, federal deficits are projected to exceed $2 trillion annually over the next decade. Not in a recession, not during a war, but under current baseline law and normal economic conditions. The CBO project's federal debt held by the public will rise from 100% of GDP in 2025 to 118% by 2035, surpassing the previous historical high of 106% reached in 1946, at the end of the most expensive war in American history. That comparison is worth holding for a moment. The United States is projected to exceed its World War II debt ratio while not fighting a world war. The debt is growing not because of a temporary emergency, but because of a structural gap between what the government collects and what it spends that has existed every single fiscal year since 2002. Our analyst, Professor Zhang Shuiqin, studies monetary systems and geopolitical order. His framework is relevant here because the fiscal data above is not a domestic American problem in isolation. The United States dollar is the world's reserve currency. That status allows the United States to borrow at lower interest rates than any other sovereign because the world holds dollars as a store of value and as the settlement currency for international trade. When that reserve status weakens, when the world begins to question whether the dollar will hold its purchasing power over decades, the interest rate at which the United States borrows rises. Rising interest rates on $37.6 trillion in debt create a self-reinforcing spiral. More interest, larger deficits, more borrowing, even more interest. Bitcoin was created for exactly this scenario, not for the moment when the spiral completes. That would be too late to act. For the moment when the arithmetic of the spiral becomes visible to the people who are responsible for allocating capital over 20 and 30-year horizons. That moment is not approaching. According to the GAO's own published data, it is already here. This is not theoretical. There is a documented historical episode where a Western banking system experienced what the downside scenario actually looks like in practice, and where Bitcoin's response was empirically measured in real time. In March of 2013, the banks of Cyprus closed suddenly, cash machines froze, account holders were locked out, and then the government, in exchange for a European Union bailout, announced that large deposits in Cyprus's banks would be subject to a one-time levy, a confiscation, in plain language, of a percentage of every large private bank account in the country. The Cyprus Popular Bank, the island's second largest, was closed entirely. Uninsured deposits at the Bank of Cyprus saw approximately 48% of their value seized to recapitalize the institution. This happened inside the European Union, inside the Eurozone, In a country where deposits were supposed to be protected by the same institutional guarantees as deposits in Germany, France, or the Netherlands, the confiscation was legal. It was approved by the Eurogroup, the European Commission, the European Central Bank, and the International Monetary Fund. It happened without warning to depositors, and it happened to people who had done nothing wrong, people who had simply stored their savings in a bank, trusting that the institution holding their money would not one day hand a portion of it to a government to cover losses they had no part in creating. The price of Bitcoin surged 87% in the 12 days following the Cyprus bailout announcement, rising from $47 on March 16th to $88 by March 28th, according to CNN Money's reporting at the time. Within that same year, the University of Nicosia became the first accredited university in the world to accept Bitcoin as payment for tuition, not because the faculty had converted to the philosophy of decentralization, because the people of Cyprus had just experienced in real time what it meant to trust a bank. Professor Jung would frame the Cyprus episode in its correct geopolitical context. What happened in Cyprus in 2013 was not a failure of capitalism. It was a demonstration of sovereign priority. When a government must choose between its own fiscal survival and the property rights of its citizens, it will choose its own survival. The lesson of Cyprus is not that all banks everywhere will confiscate deposits. The lesson is that the mechanisms of confiscation exist, are legal, and have been used within living memory inside one of the most developed regulatory frameworks in the world. Bitcoin is not a response to the probability that your bank will confiscate your deposits tomorrow. It is a response to the existence of a mechanism that allows that to happen at all. Professor Jung would frame the Cyprus episode in its correct geopolitical context. What happened in Cyprus in 2013 was not a failure of capitalism. It was a demonstration of sovereign priority. When a government must choose between its own fiscal survival and the property rights of its citizens, it will choose its own survival. This is not a critique of governments. It is a description of how sovereign power operates under conditions of fiscal stress. The Cyprus case is not isolated. Turkey's lira lost 80% of its value against the dollar between 2018 and 2023. Argentina has experienced 6 sovereign debt defaults since 1956, more than any other country. Venezuela's inflation rate exceeded 1 million percent in 2018. Zimbabwe issued $100 trillion banknotes before abandoning its currency entirely. In each of these cases, citizens who held their savings in the national currency experienced the economic equivalent of what Cyprus depositors experienced with the levy. A government-supervised destruction of purchasing power that was legal, was enforced, and was justified by the same sovereign priority logic that the Cyprus bailout made visible in real time. Researchers at K33 Research have concluded that, in general, crypto adoption tends to be higher in countries with capital restrictions, financial instability, and political instability. That finding is not surprising. It is the expected outcome when the asset that does not require a sovereign guarantor becomes relevant precisely in the countries where sovereign guarantors have failed most visibly. The question for investors in countries with more stable institutions is whether the stability is permanent or cyclical, and whether the GAO's published fiscal projections represent a stable condition or the beginning of a cycle that citizens of Cyprus, Turkey, and Argentina would recognize. Bitcoin is not a response to the probability that your bank will confiscate your deposits tomorrow. It is a response to the existence of a mechanism that allows that to happen at all, and to the question of whether you want a portion of your financial life to exist outside that mechanism before the mechanism is used rather than after. Here's the data point that should end the theoretical argument. Warren Buffett called Bitcoin rat poison squared in May of 2018. Bitcoin's price at that moment was approximately $9,800. In the 7 years since, Bitcoin multiplied in value by approximately 13 times. Berkshire Hathaway's stock tripled over the same period. Both are excellent outcomes, but one of them belongs to the person who ignored the most respected investor in American history. Buffett was right about what Bitcoin is. He was right that it produces nothing. He was right that its value depends entirely on someone else later deciding to pay more for it. Every single one of those observations is accurate. And they were consistent with a return that outperformed Berkshire Hathaway by approximately 4 times over the same period. This creates what we might call the Buffett paradox. You can be completely correct about what an asset is and completely wrong about what it does. The resolution of this paradox comes from understanding what Buffett missed. He evaluated Bitcoin as if it were competing to be the best cash flow producing investment. It is not competing in that category. Bitcoin is competing to be the best asset for a specific type of protection. Protection against the long-term debasement of currencies issued by governments that are, by their own accounting office's language, on an unsustainable fiscal path. The resolution of this paradox comes from understanding what Buffett missed. He evaluated Bitcoin as if it were competing to be the best cash flow producing investment. It is not competing in that category. Bitcoin is competing to be the best asset for a specific type of protection against the long-term debasement of currencies issued by governments that are, by their own accounting office's language, on an unsustainable fiscal path. In that competition, Bitcoin's lack of cash flow is not a bug, it is a feature. An asset that produces cash flows denominated in dollars is an asset whose real value is subject to whatever the Federal Reserve does to the dollar over the next 20 years. An asset that produces no cash flows in any fiat currency is an asset whose value is entirely independent of what the Federal Reserve does. That independence is not valuable in normal times. It is extraordinarily valuable in the specific scenario that the GAO's own data says is approaching. There is one more dimension of the Buffett paradox worth examining. Buffett's framework was built in an era of relatively stable monetary policy, balanced budgets during economic expansions, and a global financial system that had not yet spent 40 years of post-Bretton Woods fiat currency accumulating the kind of sovereign debt load that the CBO is now projecting will hit 118% of GDP by 2035. Buffett's framework is not wrong. It is calibrated for a world that the GAO says is changing. The greatest investor of the 20th century built his framework for the 20th century. The question for the 21st century is whether the conditions that made his framework correct, stable monetary institutions, sustainable sovereign debt trajectories, reliable purchasing power in the reserve currency, will persist, or whether they are already fraying at the edges that his framework does not measure. That is not a knock on Buffett. It is an acknowledgement that frameworks are built for the conditions that exist when they are built, and conditions change. This is the section of the video that most channels in this space get wrong. They present the institutional reversals as a victory lap, as proof that Bitcoin was right all along and the critics were simply wrong. That framing misses what is actually interesting about the reversals. What is interesting is not that these people changed their public statements. What is interesting is that they changed their behavior first, and their statements much later. The capital moved before the rhetoric did, and that sequence tells you everything about how seriously to take the reversal. Let me show you the three most consequential opinion changes in Bitcoin's institutional history in the order they happened. Larry Fink and the sentence he had to eat. On October 13th, 2017, Larry Fink spoke at an Institute of International Finance conference. Fink was, at that moment, the head of BlackRock, the largest asset management firm in the history of human civilization, managing what was then approximately $6 trillion in client assets. He looked at the audience and said this about Bitcoin: "It is an index of money laundering." His full quote, reported by CNBC at the time: "Bitcoin just shows you how much demand for money laundering there is in the world. That is all it is." That was not a passing remark. It was a considered public statement from the most powerful figure in global institutional finance. Bitcoin, according to the man running $6 trillion, was a measurement of criminal activity. Nothing more. 6 years later, on July 15th, 2024, Fink appeared on CNBC's Squawk on the Street and said the following, and these are his exact documented words. "I was a skeptic. I was a proud skeptic. And I studied it, learned about it, and I came away saying, okay, my opinion for 5 years was wrong. I believe Bitcoin is legitimate. It is a legitimate financial instrument." He did not qualify the reversal. He did not partially walk it back. He called his prior opinion, the index of money laundering opinion, wrong, on the record, on camera, in front of a national audience. But the reversal did not stop at calling Bitcoin legitimate. In his 2025 annual letter to BlackRock shareholders, the letter that senior executives at every major bank in the world reads, Fink wrote the following sentence, which, as of 2025, was the most consequential statement ever made about Bitcoin by a mainstream financial executive. "If the U.S. does not get its debt under control, if deficits keep ballooning, America risks losing that position to digital assets like Bitcoin." The position he was referring to was the U.S. dollar's status as the world's reserve currency. The man who called Bitcoin an index of money laundering in 2017 was warning in 2025 that unchecked U.S. sovereign debt could cause the dollar to lose its global reserve status to Bitcoin. To understand the distance traveled between those two statements, consider the context of each. In 2017, Bitcoin was trading below $6,000 and was primarily held by retail participants and early adopters. In 2025, Fink was writing as the head of a firm that had accumulated through IBIT, its Bitcoin ETF, over 800,000 Bitcoin, making BlackRock the second largest institutional Bitcoin holder on Earth. The index of money laundering had become the asset that, in Fink's own words, could replace the reserve currency of the United States. Jamie Dimon and the institution that moved faster than its CEO. Jamie Dimon's Bitcoin reversal is structurally different from Fink's, and arguably more revealing. Dimon, the CEO of JPMorgan Chase, called Bitcoin a fraud in September 2017, the same month as Fink's money laundering comment. He said at an investor conference that he would fire any JPMorgan trader who traded Bitcoin. and that Bitcoin would eventually be shut down. In April 2024, 7 years later, he called Bitcoin a fraud and a Ponzi scheme in an interview with Bloomberg Television. Here is what makes Dimon's case so instructive. On the same day in April 2024 that Dimon publicly called Bitcoin a fraud and a Ponzi scheme, JPMorgan was listed as an authorized participant for BlackRock's spot Bitcoin ETF. The largest bank in the United States, the institution whose CEO was calling Bitcoin a fraud, was simultaneously serving as the operational infrastructure that allowed hundreds of millions of dollars per day to flow into Bitcoin through the most successful ETF launch in financial history. The CEO said fraud. The institution said authorized participant. The institution moved faster than the CEO. By the end of 2025, the pattern had deepened further. JPMorgan became the first bank to issue a US dollar deposit token on a public blockchain using Coinbase's Base network. The bank's blockchain division, Onyx, had been processing billions in institutional transactions. Dimon began speaking publicly not about Bitcoin's worthlessness, but about blockchain's value, stablecoins, and tokenized settlement networks. He has not called himself wrong on Bitcoin the way Fink did. But JPMorgan's operational footprint in the digital asset ecosystem has expanded every quarter since his fraud comment, a divergence between stated position and institutional behavior that is itself a signal, the pattern that matters more than any individual reversal. Larry Fink and Jamie Dimon are not alone. Morgan Stanley launched the first bank-issued Bitcoin ETF in April 2026, the same institution whose wealth management advisors in 2023 were telling clients that Bitcoin was too speculative for a serious portfolio. Fidelity has been running its own Bitcoin custody infrastructure since 2018, 6 years before its ETF went live. Standard Chartered and Goldman Sachs now run Bitcoin trading desks. State Street's September 2025 research explicitly asks the question, can Bitcoin and gold coexist in a portfolio? Which presupposes that Bitcoin deserves to be in the same sentence as an asset that has functioned as a monetary reserve for 5,000 years. The pattern across all of these cases is identical. The institutional rhetoric changed last, the institutional capital moved first, and the gap between the private capital allocation and the public acknowledgement of that allocation spans years in every documented case. This gap is not accidental. It is the predictable behavior of large institutions that cannot afford to be wrong publicly before they have validated their position privately. They study the asset. They allocate slowly. They acknowledge the allocation publicly only after the position has been established and the analysis has been validated internally. That process, capital first, public rhetoric last, is the most important structural signal available for understanding where institutional Bitcoin adoption actually stands in May of 2026. The public statements are months to years behind the capital movements. The capital movements are the leading indicator. The pattern across all of these cases is identical. The institutional rhetoric changed last. The institutional capital moved first. And the gap between the private capital allocation and the public acknowledgement of that allocation spans years in every documented case. This gap is not accidental. It is the predictable behavior of large institutions that cannot afford to be wrong publicly before they have validated their position privately. They study the asset over months. They allocate slowly and quietly. They acknowledge the allocation publicly only after the position has been established, the analysis has been validated internally by risk committees, and the legal and compliance frameworks have been confirmed by their regulatory council. That process, capital first, public rhetoric last, is the most important structural signal available for understanding where institutional Bitcoin adoption actually stands in May of 2026. The public statements are months to years behind the capital movements. And this means that the institutions currently saying nothing publicly about Bitcoin may already be in the early stages of the process that produced Fink's 2024 reversal and Dimon's authorized participant arrangement. The silence is not evidence of absence. For large institutions navigating fiduciary obligations and regulatory relationships, silence during early stage positioning is standard practice. The data, flows, custody arrangements, regulatory filings is more reliable than the statements. There is one more reversal worth naming precisely because of how it differs from the others. Fink reversed publicly, Dimon's institution reversed operationally while he maintained rhetorical skepticism. But the most structurally significant reversal of all may be the one that has not fully arrived yet, the Federal Reserve itself. The Fed's March 2026 notices of proposed rulemaking, the Basel III proposals, do not address Bitcoin with clear capital treatment guidance. The absence of guidance is not the same as hostility. It is the regulatory equivalent of studying the asset, allocating institutional attention, and not yet having issued the public acknowledgement. The silence of the Fed in 2026 rhymes with the silence of BlackRock in 2022, 2 years before Fink said on camera that his opinion was wrong. This video does not pretend the case for Bitcoin is closed. The honest version of this analysis requires naming the bear cases that persist even after acknowledging the reversals, the ones that Buffett's framework points toward even when it does not land them with full precision. Bear case 1. Bitcoin's volatility is not declining fast enough to qualify as a stable store of value. BlackRock's own data shows Bitcoin at 54% annualized volatility as of January 2025. NYDIG's Q1 2025 analysis confirms the ratio of Bitcoin to gold volatility has narrowed to 3.6 times, down from much higher historical levels, but 3.6 is still an enormous gap. For Bitcoin to function as a sovereign risk hedge in institutional portfolios the way gold does, that convergence needs to continue. If the institutional capital entering Bitcoin creates enough demand volatility to keep the asset swinging dramatically, then Bitcoin's use as a stable store of value remains theoretically coherent but practically limited. Bear case 2. The correlation problem has not been solved. State Street's data confirms that during equity market stress events, Bitcoin has moved with risk assets, not against them. Gold posted positive returns in 6 of 7 measured S&P drawdown episodes since Bitcoin's inception. Bitcoin posted positive returns in 0 of 7. For Bitcoin to fully validate the sovereign risk insurance thesis, it needs a data point where major markets fall and Bitcoin rises or holds at scale. That data point does not yet exist. Bear case 3. The Fama scenario is not dismissible. Eugene Fama's near-one probability estimate for Bitcoin reaching 0 within a decade implies a specific mechanism. If the consensus fractures, if a critical mass of the largest institutional holders simultaneously lose confidence and exit, the absence of underlying cash flows means there is no fundamental floor. A company's stock has a floor because it has assets, earnings, and book value that persist below the stock price. Bitcoin's floor is the consensus itself. When the consensus goes, the floor goes with it. Bear case 4. The regulatory scenario has real teeth. The China ban proved that sovereign governments can close access to Bitcoin unilaterally. If the United States government, facing a fiscal crisis and a collapsing dollar, decided that Bitcoin represented a competitive threat to its ability to manage monetary policy, it has the technical and legal infrastructure to make holding Bitcoin very difficult for American citizens and institutions. That scenario would create the kind of price action that validates the Fama estimate. It is not the most likely outcome, but the Cyprus precedent proves that governments choose their own survival over citizen property rights when those two objectives conflict. Bear case 4. The regulatory scenario has real teeth. The China ban proved that sovereign governments can close access to Bitcoin unilaterally. If the United States government, facing a fiscal crisis and a collapsing dollar, decided that Bitcoin represented a competitive threat to its ability to manage monetary policy, it has the technical and legal infrastructure to make holding Bitcoin very difficult for American citizens and institutions. That scenario would create the kind of price action that validates the Fama estimate. It is not the most likely outcome, but the Cyprus precedent proves that governments choose their own survival over citizen property rights when those two objectives conflict. Bear case 5. Now, the argument from history cuts both ways. Bitcoin advocates point to Cyprus, Turkey, and Argentina as evidence that sovereign systems fail and Bitcoin fills the gap. The counterpoint is that even in those cases, citizens primarily turn to dollars, not Bitcoin. The Argentine peso crisis did not produce mass adoption of Bitcoin as a store of value. It produced mass adoption of US dollars, held in cash, distributed through informal exchange networks. Turkey's lira crisis produced demand for foreign currency, primarily dollars and euros. The revealed preference of citizens fleeing failing sovereign currencies has historically been for a different sovereign currency, not for a decentralized protocol. Bitcoin's case for the hyperinflation scenario requires Bitcoin to win the competition against the dollar as the default refuge asset, and that competition has not yet been decided. Bear case 6. The 21 million coin supply is a protocol constraint, not a natural law. The 21 million cap is enforced by consensus, meaning it persists as long as the network's participants continue to run software that enforces it. A sufficiently motivated and sufficiently coordinated coalition of miners, node operators, and institutional holders could theoretically coordinate to change it. This has not happened, and the social and economic incentives against it are extremely strong. But the framing of the supply cap as immutable deserves qualification. It is immutable by consensus, not by physics. And consensus, in systems of human coordination, is always subject to revision under sufficient pressure. These bear cases do not eliminate the case for Bitcoin. They define its boundaries. The honest version of the Bitcoin investment thesis acknowledges that the thesis is true only if the sovereign debasement scenario materializes at a speed and scale that outpaces regulatory response. Bitcoin wins the competition against gold and foreign currency as the preferred refuge asset. and the network's consensus around the supply cap holds under conditions of institutional scale entry and sovereign level pressure. None of those conditions is guaranteed. All of them are currently in motion. Now, let me show you the data point that closes the intellectual argument. Not a theoretical framework, not a philosophical observation, a specific, measurable institutional behavior that tells you what the smartest capital allocators in the world have concluded after studying all four bear cases. In 2025, Bitcoin's price fell approximately 30% from its all-time high of $126,000 reached in October of that year. The asset was underwater for most institutional investors who had entered near the top. The bear case was not theoretical. It was happening in real time, costing real institutional money in real portfolios managed by people with fiduciary obligations to their clients. BlackRock's iShares. Bitcoin Trust attracted $25.4 billion in net inflows during that same year. It ranked 6th among all ETFs in the United States by net capital raised in 2025. It was, as Bloomberg ETF analyst Eric Balchunas documented, the only ETF in the top 25 by inflows that posted a negative return for the year. Every other fund in the top group was attracting capital because it was performing. The IBIT was attracting capital while losing money for its investors, buying the drawdown in a structured, systematic way that does not describe speculative behavior. It describes a long-term thesis allocation. The comparison that makes this data most legible. Gold delivered its best annual performance since 1979 in 2025, rising approximately 64%. The SPDR Gold Trust attracted less capital than IBIT. A losing Bitcoin ETF raised more money than a winning gold ETF. Balchunas called it a Hodel clinic from boomers, a description of long-term institutional investors who were not buying Bitcoin because of short-term price momentum. Total IBIT inflows since launch now stand at $62.5 billion, the fastest accumulation of assets under management in ETF history, faster than gold ETFs, achieved in their first 2 decades combined. Institutional capital does not accumulate at this velocity on speculation. The people managing pension funds, endowments, and sovereign wealth funds are not buying Bitcoin because they watched a promotional video about future price targets. They are buying it because their risk models, the same risk models that process the GAO's fiscal data, the CBO's deficit projections, and the historical record of sovereign deposit confiscation, are telling them to hold a portion of their assets in something that governments cannot print more of. Institutional capital does not accumulate at this velocity on speculation. The people managing pension funds, endowments, and sovereign wealth funds are not buying Bitcoin because they watched a promotional video about future price targets. They're buying it because their risk models, the same risk models that process the GAO's fiscal data, the CBO's deficit projections, and the historical record of sovereign deposit confiscation, are telling them to hold a portion of their assets in something that governments cannot print more of. There's a behavioral finance observation embedded in this data that is worth naming explicitly. In 2013, the year of the Cyprus crisis, the gold ETF GLD experienced approximately $25 billion in outflows as gold's price fell 28%. Investors exited their gold position when it was losing money. In 2025, IBIT attracted $25.4 billion in inflows as Bitcoin fell 30%. The behavior of Bitcoin ETF investors in a losing year was the inverse of the behavior of gold ETF investors in a losing year a decade earlier. The Bitcoin ETF holders bought the drawdown. The gold ETF holders sold it. That behavioral difference is not a coincidence. It reflects a different investor base with a different thesis. The gold investors in 2013 were largely tactical. They owned gold because it was going up, and they sold it when it stopped going up. The Bitcoin ETF investors in 2025 appear to be structural. They own Bitcoin because of a long-term thesis about sovereign debasement risk, and that thesis does not change when the price falls 30%. Bloomberg's ETF analyst Eric Balchunas described the 2025 IBIT inflow data as proof that if a Bitcoin ETF can attract more than $25 billion in a year marked by negative returns, the potential for substantially larger inflows during a strong market environment could be considerable. The floor under future Bitcoin drawdowns is being built not by speculators buying momentum, but by institutional capital deploying a structural thesis regardless of price. Let me put specific numbers on both sides of this argument because this video should leave you with a framework, not just a narrative. The case against Bitcoin: 34 bear markets since 2015, a volatility ratio of 3.6 times gold, 0 positive performance in 7 measured S&P stress episodes, a Nobel Prize winning economist assigning near 1 probability to its eventual worthlessness, and a documented regulatory precedent of total sovereign ban in the world's most populous country. The case for Bitcoin: $37.6 trillion in federal debt growing at $2.2 trillion per year, $1.2 trillion in annual interest payments that already exceed defense and Medicare, a GAO projection of 200% debt to GDP by 2047, a documented historical precedent of deposit confiscation inside the European Union in 2013, and $62.5 billion in institutional ETF capital allocated by the people who manage pension beneficiaries' retirement savings, not by retail momentum chasers. Neither list is complete. Neither list is propaganda. Both lists are sourced from the same institutions that the critics of Bitcoin cite as authorities: the GAO, the CBO, BlackRock, the Basel Committee, the European Central Bank, the International Monetary Fund. Here is the intellectual structure that ties the argument together. Bitcoin's critics evaluate it as an asset competing in the traditional investment universe against stocks, bonds, and gold on the traditional metrics of cash flow, intrinsic value, and price stability. On those metrics, the critics are right. Bitcoin loses. Bitcoin has no cash flow, no intrinsic value in the Buffett sense, and its price stability is the worst of any major asset class. Bitcoin's case is not about those metrics. Bitcoin's case is about a single specific scenario. What happens to your financial position if the institutions that manage the money supply make decisions that systematically reduce the purchasing power of that money over a 20 or 30-year period, and you have no asset that is immune to those decisions? On that metric, sovereign debasement resistance, Bitcoin has no peer in the modern financial system. Gold is a partial answer. It has a 3.6 times lower volatility and a 5,000-year track record. But gold also has a government-adjustable mining supply, a physical custody cost, a confiscation history during the 20th century in the United States, and a maximum supply that is a geological estimate rather than a mathematical certainty. Bitcoin's supply is 21 million. Not approximately 21 million. Exactly 21 million. Baked into the protocol, enforced by the same mathematical consensus that processes every transaction on the network. That number cannot be changed by a central bank decision, a congressional vote, or presidential executive order. It is not a policy, it is a protocol. And in a world where the primary counterargument to holding sovereign debt is that sovereigns can print more of the thing they owe you, the existence of an asset whose supply cannot be printed is not a niche philosophical position. It is the technological answer to a structural problem that the United States Government Accountability Office has now formally documented as unsustainable. Now let me show you the intellectual distance that the key actors in this story have traveled in 8 years. In 2017, the man running the world's largest asset management firm called Bitcoin an index of money laundering. In 2025, the same man wrote in his annual shareholder letter, the most read document in institutional finance, that unchecked American debt could cause the dollar to lose its status as the world's reserve currency to Bitcoin. The distance between those two statements is not a rhetorical change. It is an 8-year journey through the data. Fink studied the GAO numbers. He reviewed the CBO projections. He looked at what Cyprus depositors experienced. He looked at what Turkey and Argentina citizens experienced. And he came out the other side saying, on the record, in print, in a letter that every pension manager in the world reads, that the scenario Bitcoin was built for is not a paranoid fantasy. It is a described, projected, documented fiscal trajectory that the US government's own auditors have called unsustainable. The critics who hate Bitcoin are right about what it is. They are wrong about what it is for. The most powerful institutional players in global finance, the ones who hated it loudest and longest, are the ones whose behavior, whose capital allocation, and in Fink's case, whose own written words, now make that distinction most visible. Warren Buffett may still be right that it goes to zero. Eugene Fama's probability estimate may prove correct. The regulatory scenario may materialize. The consensus may fracture. All of those outcomes are possible. But the people who study these risks for a living, who manage trillions of dollars in fiduciary capital, who built their careers on the framework Buffett perfected, those people are buying Bitcoin through drawdowns, running its infrastructure, and warning that the asset that their predecessors called rat poison squared might one day replace the reserve currency of the world's largest economy. That is not a rounding error. That is a signal. In 2017, Larry Fink called Bitcoin an index of money laundering. In 2025, the same Larry Fink wrote in his annual letter to shareholders that unchecked U.S. sovereign debt could cause the dollar to lose its global reserve currency status to Bitcoin. Between those two statements, the man ran the most successful ETF launch in financial history with a Bitcoin product. Between those two statements, he said on camera, "I was a proud skeptic. My opinion for 5 years was wrong." In 2017, Jamie Dimon called Bitcoin a fraud. In 2024, on the same day he called it a fraud again publicly, JPMorgan was listed as an authorized participant for the Bitcoin ETF that became the largest in the world. The institution moved before the CEO's rhetoric did. By the end of 2025, JPMorgan was processing institutional blockchain transactions through its Onyx division, had issued a deposit token on a public blockchain, and Dimon had stopped attacking Bitcoin by name and started discussing stablecoins, tokenization, and blockchain settlement infrastructure. The CEO did not say he was wrong. The institution simply built a digital asset operation that would have been impossible under the framework of his 2017 position. Buffett remains unchanged. He has not bought a single Satoshi. He has not changed his public position by a single sentence. He is the most successful investor of the 20th century. And he may be right that Bitcoin eventually goes to zero. The possibility is real, documented, and taken seriously by people who are simultaneously buying it in large quantities. The bear case is not gone. It is simply being weighed against a different set of risks by a different set of people with different time horizons and different portfolio objectives. But here's what the data says about the people who have looked most carefully. The people who called Bitcoin an index of money laundering are now warning that it might replace the dollar as the global reserve currency. The people who called it a fraud are running the infrastructure that processes billions in daily Bitcoin ETF flows. The people managing pension capital are buying it through a drawdown, while gold is having its best year since 1979. And the U.S. Government Accountability Office, the nonpartisan watchdog of the United States Congress, published a report in February 2025 that used the word unsustainable to describe the fiscal trajectory of the country that issues the world's reserve currency. Buffett's argument is correct about what Bitcoin is. The people who changed their minds did not stop understanding the argument. They understood a different risk more clearly. The risk the GAO calls unsustainable. The risk that Cyprus depositors experienced without warning inside the European Union. The risk that the white paper was written to address in the middle of the largest bank bailout in American history on Halloween night in 2008 by a person or group who embedded a newspaper headline about a second bank bailout into the first block of data ever recorded on the Bitcoin blockchain. The critics who hate Bitcoin are right about what it is. They are wrong about what it is for. And the most powerful institutional players in global finance, the ones who hated it loudest and longest, are the ones whose subsequent behavior makes that distinction most visible. If this video showed you the version of this argument you have never heard before, the one that respects the critics fully and still builds the case honestly, that is the signal. Hit the like button right now. It costs you nothing, and it puts this analysis in front of the people who need it most. Subscribe and turn on the bell. Drop your comment below. 3 things: your city, the time, and the weather. And tell me this: which critique of Bitcoin do you think is the hardest to answer? Even after watching this video, I rate every single one, and the question this community keeps asking becomes the next video.